How can banks handle the problem of financial crime? Why is it that this is still such a hard risk to deal with? And why do we keep seeing anti-money laundering breaches in the news? As financial firms get to grips with the new normal of operating in a post-COVID world, it's important for us to remember some of the really big unresolved challenges that the sector was facing before the pandemic. One of these was the challenges the European banking sector faces in spotting and fighting cases of financial crime. I'm Scott Martin from Deloitte Center for Regulatory Strategy, and you're listening to Regulated Radio. I'm excited to have Katie Jackson and Tamsin Baumann from Deloitte's financial crime team on the show today for our latest Working From Home podcast. We'll be talking about some of the newest regulatory initiatives from authorities in the EU and the UK, what some of the common money laundering challenges are that we see across the sector, and how the most innovative banks are deploying leading solutions to overcome them. Now, this is a topic I've been looking forward to having on the podcast for a while. And when you hear what our guests have to say, I'm sure you'll agree that it's a problem that needs really urgent attention. So let's get started. This is Regulated Radio. I remember back when the new European Commission took office late last year, a lot of us were looking for signals about what was going to be at the top of their financial services agenda. Now, as you'd expect, all of the really big projects like completing the banking union and the capital markets union were up there, but so was a renewed focus on the regulatory framework around financial crime. Europe's banking sector has seen a number of high-profile cases where banks were challenged to identify and deal with money laundering, and the tools available to regulators to address this were not seen to be as effective as they should be. Policymakers in the EU, the UK, and elsewhere has made it clear that taking on financial crime in the banking sector was going to be a core part of the regulatory agenda going forward. So, as mentioned, I'm delighted to have Tamsin Baumann on the show. Tamsin is a partner in Deloitte's UK forensic practice, where she helps our clients investigate money laundering and sanctions violations and advises them on how best to manage regulatory requirements around financial crime. Tamsin, welcome to the show.
Thanks, Scott. It's nice to speak to you this afternoon.
So Tamsin, maybe to help our listeners understand the topic a bit better, when we talk about financial crime in the financial services sector, is there a way of thinking about the different kinds of activity that banks are trying to guard against?
Well, the FCA defines financial crime to be a broad range of activities involving any kind of criminal conduct relating to money or to financial services or markets. In practice, financial institutions consider money laundering, financial sanctions, bribery and corruption, and the facilitation of tax evasion under the umbrella of financial crime. So let me bring that to life with an example. Individuals known as money mules may be asked by criminals to pay cash into their bank account and pass that money on to someone else in return for a fee. Effectively, what they're doing is allowing criminals to access their bank account and help those criminals integrate the proceeds of crime into the banking system. More recently, what we're seeing is that institutions have broadened the definition of financial crime to include other predicate offences such as modern-day slavery and wildlife trafficking. And we're also starting to see other risk areas such as fraud and cybercrime being integrated with the more traditional components of financial crime. Interestingly, what we've seen is in the past a cycle where financial crime and fraud were looked at together, separated, and now we're seeing a trend to bringing them back into one place. But this is all indicative of an increasingly holistic approach to financial crime risk management being adopted by financial institutions.
All right, thanks, Tamsin. Now I'd like to bring in Katie Jackson. Katie is the partner leading Deloitte's UK financial crime practice. She has decades of experience working with financial services firms, both as a consultant and in-house, and she's also previously been part of the enforcement division of the UK Financial Services Authority. Katie, it's good to have you here.
I'm delighted to be here. Good afternoon.
So, Katie, maybe just to start off, why is there such a high level of focus on the banks when it comes to the broader regulatory focus around financial crime in the broader economy?
So banks really are the gatekeepers to the financial system, and they control the flow of funds and the mechanism ultimately to clean dirty money, as Tamsin just explained with the money mules example that she spoke about. So criminals can easily move funds between jurisdictions, countries, and even domestically, and it's difficult to track the money moving once it has actually entered the system. But the key is getting the money into the system in the first place. Once the money is in, it's incredibly easy to then transfer funds across entities and across international boundaries, and therefore conceal the true origin and the original source of that money. Banks are the key enablers of the global movement of funds, and with high-speed transactions at low costs, which we've seen the transformation in recent years, this is only increasing. There are also increasing expectations from customers around faster payments, and the nature of global payments and the speed with which these transactions happen only makes it easier for the criminals to move around undetected. They can swiftly make payments and disappear before anyone has even noticed the transaction has taken place. So the banks are not the only target of the regulatory focus. We mustn't forget the regulated sector doesn't just include banks anyway. This is much wider across the financial services industry and also includes other regulated activities such as trading, casinos, estate agents, lawyers, and even accountants. But banks really are key as they are the ones controlling the movement of funds.
So just to add to that, the implementation of the 5th EU Money Laundering Directive further expanded the scope of regulation to cover non-financial firms such as virtual currency providers and art dealers, recognising that there are other organisations that are capable of enabling financial crime to happen. So whilst the banks are the gatekeepers into the system, other sectors outside of the banking sector have a role to play to detect and respond to financial crime. They all need to recognise their role as part of the defence mechanism against illegal activity.
Perhaps let me jump in there, Tamsin, and bring that to life with an example. So whilst a bank may facilitate a payment between a UK supplier and their customer who is committing money laundering, the supplier company is actually the one dealing with the illegal activity directly, and arguably, therefore, has a greater ability to understand and identify this illegal activity than the bank, who is one step removed. The supplier should have adequate controls in place to guard against this scenario, but this is not necessarily always the case.
So, Katie, in May of this year, the European Commission adopted its action plan for an EU-wide approach to preventing money laundering and terrorism financing. Now, among the various initiatives that sit under that umbrella of the action plan, what stands out to you as potentially the most important for financial services?
So the European Commission's action plan builds on 6 pillars, which are the effective implementation of existing rules, a single EU rulebook, EU-level supervision, support and cooperation mechanism for financial intelligence units, better use of information to enforce criminal law, and overall a stronger EU in the world. Of those 6 pillars, the proposal to either establish a new EU-level supervisory and enforcement body or add additional powers to the European Banking Authority to fight financial crime has the potential for more effective regulation. Now, this could be through a single standard enforced by the new EU-level supervisory and enforcement body that is applied equally to all European supervised institutions. So currently, even though the laws may be the same in different EU countries, the enforcement of the law has often been criticised as being inconsistent between EU countries for a number of reasons, including the appetite for enforcement as well as their ability and resources. And that's been quite widely criticised and commented on in the press, particularly of late. The European Commission intends to deliver on all these pillars by early 2021 and has launched a public consultation in parallel to the adoption of this action plan. Off the back of a number of recent high-profile money laundering scandals, again, which most of you will have read about in the press, this has really highlighted the lack of local effective supervisory bodies in the execution of the effective oversight of firms. I think an important point here is to think about the actual implementation of the action plan as well, rather than the plan itself. So, for example, the effective implementation of existing rules, if this had been successful, would other scandals have happened? The other point to highlight here is related to the support and cooperation mechanism for financial intelligence units. Because as we all know, criminals don't restrict their activity across Europe based on national boundaries. In fact, they actively take advantage of the different regimes in place, the different approaches by law enforcement, and the international political diversity of financial crime regimes. So this slows down any activity to respond to illegal activity and prevents the effective approach in the fight against financial crime. And I reiterate, the point that this pillar could, if implemented properly, be instrumental. But as I said, that's definitely one to watch. And just finally, it's also worth noting in the EU that Europol recently launched a new European Financial and Economic Crime Centre. And there's explicit reference in the report to the continuing convergence of cyber, fraud and financial crime. So going back to our earlier point on the holistic approach to financial crime, this is another area that firms should be mindful of as they plan their approach to combating financial crime.
So Tamsin, I'd like to shift the discussion for a moment to the UK, and I'm wondering what government or regulatory initiatives on financial crime are you watching most closely right now?
So last year, the UK government, in collaboration with UK Finance, which is the trade body for financial institutions, published the Economic Crime Plan, a 4-year plan which defines how the public and private sectors have agreed to work together to tackle economic crime. The plan sets out 7 key priorities, including the pursuit of better sharing and usage of information between public and private sectors, strengthening the capabilities of law enforcement, the justice system, and private sector to detect, deter, and disrupt economic crime, building greater resilience to economic crime by enhancing the management of economic crime risk in the private sector and the risk-based approach to supervision, and the improvement of systems for transparency of ownership and legal entities and legal arrangements. We are currently working with the UK Home Office on an important piece of work that ensures Deloitte is at the heart of shaping the reform agenda articulated by the UK government in both the Economic Crime Plan, the Anti-Corruption Strategy, the Asset Recovery Action Plan, and the Serious and Organised Crime Strategy. The engagement involves us helping them define a target state blueprint for tackling economic crime across the UK and building a performance measurement framework to assess the costs and benefits of the whole system together with the impact of interventions. Just turning our attention to the current climate, law enforcement agencies are highlighting increased financial crime risks as criminals take advantage of the global pandemic. For example, supply chain fraud through the sale of fake PPE and theft of personal details primarily through phishing emails. The FCA has emphasised that there is no reduction in their expectations for firms to focus their efforts on financial crime risk management.
All right, now Katie, forgive me if this is somewhat of a silly question, but why is this hard for banks to do? Now, I can understand how it can't be easy to monitor the risks across such a huge volume of financial activity, but what would you say are some of the common institutional failings that lead to the kind of money laundering scandals that we see in the news?
That's a great question. And it's interesting and probably quite surprising. But where would you like me to start? Firms continue to get the basics wrong. Understanding who their customers are, the nature of their business over the course of their relationship, understanding the key regulatory requirements, and understanding the application of those requirements in practice and what that actually means for their business. They continue to get wrong. This is about how do criminals try to exploit and gain access to the organisation. The way they do that with each organisation is different from another. And each organisation really needs to understand what their risks are and to protect themselves accordingly. There is absolutely no one-size-fits-all approach or a prescriptive rulebook that tells you exactly what to do. You have to understand, apply judgment, and this often presents problems for firms. In addition to that, you need to evidence the steps you've taken and why you've taken those steps. And firms also seem to struggle with this concept too. It's not helped really by today, the fact that firms are increasingly operating across multiple legal entities, typically using multiple legacy systems which don't talk to each other, and they really haven't been designed with financial crime risk management in mind. There's also a lack of capability in some areas of the market, particularly in what we refer to as the first line of defence. And many firms are still relying too heavily on their compliance and risk functions to really understand and deal with financial crime. There's also a lack of clearly defined accountability and ownership for financial crime, as well as a lack of tone from the top. And culture is a real hot topic at the moment in terms of actually helping firms, or some firms are really turning a blind eye to certain activity because it was making them so much money. And again, we've seen evidence of that from some of the articles in the press recently. If you think more broadly about the history of banking, financial crime is relatively a new concept, and it is definitely not as well embedded as other areas such as credit, which have a direct impact on the bottom line. Financial crime is more about doing the right thing and deterring criminals from using the banking system for their own illegal gains. And there just hasn't been as much focus in the past on this area compared to others. There's also been less incentive to get this right, hence why we now, or more recently, have seen the huge fines in the last decade or so, which are now making people sit up and take notice. But this does take time to embed in a sustainable way.
Now, Tamsin, I could be wrong with this, but it seems that when we talk about financial crime and breaches of money laundering standards, we're normally talking about very large banks, very large financial institutions. But what about some of the smaller challenger banks? Do you think that they could potentially face some financial crime-related growing pains with the very rapid expansion of their client base that they're targeting?
No, you're right, Scott, and we have seen exactly that. There is often a tension in these organisations between the desire for rapid growth, and that's usually through a focus on customer experience as they try to attract those customers away from the traditional institutions, and between financial crime compliance. So while challenger banks often benefit from simpler technology and data architectures, enabling them to better harness new technologies and drive greater efficiency, managing financial crime imposes significant cost on a financial institution. So a few years ago, trade institutions were estimating that British banks spend around $5 billion per annum combating financial crime. So the cost, combined with often a lack of maturity and capability within those organisations to effectively assess and manage risks, means that in some cases compliance is just an afterthought, creating potential issues in their financial crime framework and operating models that have not grown in line with the scale of the business.
Now, Katie, maybe just moving on from that, in the work that you've done with our clients, what are some of the industry-leading best practices that you've seen a firm adopt, but also that you think the whole sector should be considering taking on?
So I think having a strong ethos of understanding the root cause of financial crime activity and the control failings that have led to that, which are then fed back into the business to enhance and improve their current approach. And this is what we refer to as a culture of continuous improvement. And just on that point around culture, culture has a very important role to play in detecting and responding to financial crime. It's critical that the tone from the top of an organization drives programs and builds awareness so that financial crime risk management becomes part of the DNA of the organization. We've also seen a move towards more proactive use of intelligence to make more targeted and effective identification of the risks that a business faces, and will allow them to identify the biggest issues or the anomalies that stand out and therefore need to be addressed. And this is about being proactive rather than reactive, recognizing that it is customers who commit crime, not transactions or payments. That's just the behavior or the activity by which they commit this activity. Hence the importance of understanding your customer base, which we spoke about at the beginning of the discussion, and really denying criminals access to the financial system. Another area is around embedding accountability for financial crime across all lines of defence, particularly with the business, who are the ones that are interfacing with the customers on a day-to-day basis. And then I think the final point on this area is that leading firms really are taking a much more holistic view of financial crime, but utilising different sources of information, drawing that all together and really building a picture of customers that they have and who they're dealing with to identify those that may be involved in illegal activity. So, for example, data on surveillance, customer information, transaction monitoring data, external data and IP addresses, and pulling all of that together to really get a true and in-depth understanding of who your customers are and what they should be doing.
And just to add to that, I was just going to come back to the point around the economic crime plan, because this is where it's so important, the success of that plan, in providing the nexus between public and private stakeholders so that they can share that information and enhance intelligence across both sides of the equation.
I think that's really interesting. And just digging a bit deeper into the best practices question, how are you seeing firms deploy new technologies to do a better job at managing the risk of financial crime?
It's interesting because the regulator, has really opened the door to the increased use of digital means to identify customers. And this is where digital identity really starts to play a role. We've been working with consulting across the firm to develop a new way to conduct Know Your Customer, or KYC, where the customer owns and controls their identity and gives permission to others to access it, rather than providing documentation and papers and passports and utility bills to multiple financial services firms. And this new technology has the potential to really revolutionize the market once it has been widely adopted.
So I always like to end the show asking our guests to make a prediction. And there's clearly going to be a lot of change in the regulatory environment around financial crime over the next few years. But if you look ahead by 5 years or so, what's one thing that you think regulators might still be struggling to get right? And one thing that you think the banking industry will still struggle to get right? So Tamsin, how about you?
Okay, so I'll start with the regulation. I think regulation and regulators are just simply struggling to keep pace with the criminals. So the criminals always seem to be one step ahead. And the authorities simply can't legislate fast enough for their activities. So a really good example is virtual currencies. It's taken a significant amount of time for the regulators to really get to grips in terms of what does that mean from a financial crime perspective. They are simply not agile enough and swift enough to respond. And unfortunately, I don't see that changing in the next few years. Looking at banks, I think we will still see banks struggling to get this right, because there's this constant pressure between the competing priorities of achieving compliance and spending sufficiently to maintain those effective systems and controls, whilst keeping costs down and delivering profit. So there's that constant balance the banks have to achieve in order to maintain a certain level of compliance, but not at a significant cost to their business.
And Katie, what do you think?
Yeah, I think that's a really good point, actually. And if we turn to think about how that might apply in the current environment, the pressure that we face in the current global economic climate is really bearing down on the cost base of the banking industry. Yet they still seem to need to spend significant sums of money to enhance, build and sustain their financial crime controls. You just look at the most recent example with Wirecard. There are forever competing priorities, but the key is to drive cost efficiencies out of the business. But you have to get the basics right first. So what I think we will see is an increasing use of intelligence to drive and deliver cost-effective management of financial crime risk. Where I spoke about before, they use a range of intelligence to highlight the areas of focus with perhaps less attention and therefore lower cost on areas which pose a lower risk to the banking industry, rather than trying to cover all bases. But it has to be more risk-focused, leveraging multiple sources of intelligence. And I think that's what we will see in the future.
All right, Katie, Tamsin, thanks so much for coming on the show.
Thanks.
Thank you very much.
Pleasure to be here.
And there you have it, a lot of risk to consider and still a lot to do for both banks and regulators to get to grips with financial crime. Now, I think we're getting the hang of doing regulated radio from home. I've got a whizzy new microphone now delivered from the friendly folks at Deloitte Marketing and Creative, and I'm thrilled that we've been able to bring you a lineup of leading guests over the last few months. But if you have thoughts for our next show in our Working From Home series, please give us a shout at regulatedраdio@deloitte.co.uk. We really would love to hear from you. And remember, if you like the show, hit the subscribe button to ensure you receive notifications about our next episodes. And if you're already subscribed, you can give us a review on wherever you get your podcasts. But that's all for now. Thanks so much for joining us, and you'll hear from us again soon.